Hello friends. Last week in my video, I said that Indian markets would continue to outperform its global peers because of the simple relative strength that we are exhibiting. Well, that really happened. Look at the way the US markets have fallen and our local markets have held their ground. What is likely to occur in the coming week is something that I want to discuss in this video. I'm a little under the weather, so I'm using a voiceover instead of a pure video. The graphics and charts will remain as usual. I hope you're going to bear with that minor inconvenience. Jumping to the market roundup window on your screen, what we are seeing is that the Nifty fell mildly, whereas the Bank Nifty gained a little over 1%. The US dollar index, the Dixie, rose 77 basis points, and that basically exerted downward pressure on commodity markets, including bullion, crude oil, natural gas, and other emerging markets. The USD INR, the US dollar versus the Indian rupee, eased 2 basis points to 80.06. The 10-year benchmark bond yield was constant, and the NSE actually gained a little over 0.5% in market capitalization. MWPL continued to rise, and the US markets, as you can see, continued their decline. On your screen right now is the daily chart of the Dow Jones Industrial Average, and what you are seeing is a decline on 4 out of 5 trading sessions. The death cross, where the 50-day moving average is below the 200-day moving average, continues, and the 50-day average is actually accelerating downwards. The 31,886 level, which was a last mile support for the Dow Jones Industrial Average to defend, was violated. And that tells you that the outlook is weak. Looking at the Nasdaq 100 index, here again, what we are seeing is a death cross in place. The bullish triangle is violated. The price is below its 50-day moving average, and this index has a direct bearing on our technology stocks. Do remember, I have recorded a video wherein I've dispelled the myth that a falling rupee versus the dollar is necessarily positive for technology stocks. The hyperlink to that video is in the description and in the pinned comment below. The S&P 500 has managed to take support at the bullish triangle, but the death cross remains in place, and the last mile support will be violated if this index breaches the 3,900 mark. Net, US markets are under pressure. Coming back to our domestic markets, the MWPL is showing signs of rising. This is the third expiry wherein we are seeing higher bottoms. Whether a higher top will follow is something we need to see. Whether 31.13, which is the peak reached in the August derivative series, will be overcome or not, that remains to be seen. The stock and index futures turnover on a time period of 20 weeks shows a mild pickup in the index futures, whereas the stock futures were more or less flat where turnover is concerned. So nothing really great happening there. Let's not forget, we had a truncated week due to a holiday due to Ganesh Chaturthi in India. The NSE Nifty and Bank Nifty basis analysis. The basis is nothing but the premium or discount prevalent in the future vis-a-vis the spot segment. Basis has come down by almost half in the Bank Nifty and less than half in the Nifty 50. No great surprises there. These lofty basis levels I told you last week were unlikely to hold. And what we are watching out for essentially is inversion, which means if the basis goes into negative and the future trades at a discount to cash, that would indicate a higher selling pressure. As long as that is not happening, the bulls still have a fighting chance. The NSE advanced decline ratio fell back below 1. That is basically a gauge of one marshmallow traders, intraday short-term traders, and they were on the back foot last week. We need to see whether this leading indicator, after the price, this is the fastest indicator to tell us which way the winds in the market are blowing. Monitor the advanced decline ratio in real time throughout the week. Now for the impetus, no great surprises in the impetus chart. The Nifty impetus has fallen almost to the lowest point in the 20-week look back period. And that is because the Nifty actually suffered a mild loss. The Bank Nifty impetus rose a little bit, and that is because the Bank Nifty actually gained a little over 1% last week. So there was a little bit of buying momentum in the Bank Nifty, and we need ideally the prices and the impetus to rise together so as to indicate a sustainable uptrend. Now for the LWTD, both the Nifty percentage gain loss line and the LWTD are below zero. This is happening after a while. What that indicates is a weak support coming in from the bulls, at least on Monday. I update this indicator late evening every day, so do connect with me on my social media accounts and keep ahead of the crowds by updating yourself with our in-house exclusive indicators. Now for the footprint of the four market participants, I start with the FIIs. Where FIIs are concerned, they continue to unwind their individual stock futures long positions, and they continue to build up their short positions in index futures. Where DIIs are concerned, reduce their short position in individual stock futures and reduce their short position again in index futures as well. Prop traders, these are brokers, own proprietary trades. They know who's buying, selling, how much. So they are second best to insiders. They've raised their individual stock futures long positions and they've cut their index short position. So they seem to be more optimistic on the market. Where the retail guys are concerned, they've been doing all the heavy lifting since the COVID-based lockdowns. Their index futures net long positions have crossed 100,000 lots mark after many weeks. And their individual stock futures longs are also a whisker below the 1 million lots mark. So we need to see what the retail and the prop are doing. Now, friends, the four heavyweight stocks in the Nifty, and some of these stocks are also weighted in the Bank Nifty. So what happens to these counters determines what happens to the market. We start with the biggest boy, Reliance, with a weightage of 11.51% in the Nifty with a beta of 1.11. So if the index moves 1%, this stock moves 1.11%. Reliance has fallen on 3 out of 4 trading sessions last week, and it has violated the 2,542 level, which is something that should not have happened. Ideally, if at all the Nifty is to gain, Reliance should go above the 2,618 mark, and unless that happens, the Nifty might feel some amount of pressure. HDFC Bank, the second heavily weighted Nifty stock with a weightage of 8.36%, and the heaviest weighted stock in the Bank Nifty with 26.21%. That has basically held fort and stayed above the 1,421 mark and above its 25-day exponential moving average, which is a proxy for a 1 month long holding on cost of a bull. As soon as it crosses the 1,525 mark and stays above it, I think HDFC Bank can support the Nifty and the Bank Nifty fairly well. Infosys, do remember the Nasdaq 100 is extremely weak and the chart of Infosys itself is extremely weak. Note how it has come down with gaps. That's not a good sign. And not only has it come down with a gap, but the 1,555 level is now proving to be a very major hurdle. We need to cross that and close the gap at 1,728 as well. A very, very long road ahead for Infi. So Infi is dragging the index down. The strongest chart out of the four is ICICI Bank. It has managed to stay above the 867 levels and above its 25-day exponential moving average, which is a month-long holding on cost. And this stock has a weightage of 7.57% in the Nifty and 23.72 in the Bank Nifty. And it's likely to support both the Nifty and the Bank Nifty proactively. Friends, these charts done, I now come to the bond markets, which are basically showing that the yields remain more or less the same on a week-on-week basis. And the round number of 7% still is being defended by the markets. My viewers who've been laddering bonds are now should be feeling relieved that they did so, because yields are now tapering off, although I do think that a fall below 7% seems unlikely in a very short period. So do monitor what's happening. Do remember that we have a monetary policy committee meeting coming up, and the markets will start conjecturing as to which way the winds will blow. Bond markets done. I now come to the US dollar index, extremely critical for emerging markets, including India, because we are import dependent, and the dollar determines the landed price of goods that we import. It has closed above the 109.25 level, which I talked about last week. Price is above its 25-day exponential moving average, which is a month-long holding on cost of an average bull, which means the short-term outlook is positive. The dollar index is likely to determine the outlook for crude oil, natural gas, bullion, and also our equity markets to a certain degree. The weekly chart on your screen tells you that the rally has persisted for the third week in a row, and the price is above its 25-week exponential moving average, which is a 6-month holding on cost of an average bull, which means the medium-term outlook is also positive. Last week, I advocated a range between 110.75 on the upside and 106.95 on the downside, which held perfectly well. In the coming week, I expect a range between 111.50 on the upside and 107.75 on the downside. Friends, the dollar index done. I now come to the Bank Nifty, which outperformed the Nifty 50. It rose on 2 out of 4 trading sessions last week and has managed to stay above the 38,759 levels, as you can see on the daily chart on your screen. We need to defend this level in the coming week, especially on a closing basis. As long as that happens, the outlook is positive. The index is above its 25-day exponential moving average, which is a month-long holding on cost of an average bull. So the short-term outlook is positive for now. Looking at the weekly chart, it got off to a shaky start, but what a roaring big power candle. And what we are seeing is that the Bank Nifty is now closing at its highest in many, many months. The price is far above its 25-week exponential moving average, which is a 6-month holding on cost of an average bull. That leaves the possibility of a corrective decline. Remember, I'm using the word correction, not reversal. So mean reversion might just happen because the price might come down to close the gap. That apart, I don't expect too much by way of a decline. In the week before last, this index was number 4 on our in-house statistical beta list, which is the list of most volatile counters. And it fell 1 notch to number 5, which is a relief because volatility coming down is always a positive aspect. Last week, I advocated a range between 40,500 on the upside and 37,475 on the downside, which held perfectly well. in the coming week, I expect a range between 40,950 on the upside and 37,900 on the downside. Do trade extremely carefully, keep your stop losses and trade light, my friends, because volatility might just be elevated. Friends, I now come to the Nifty 50, which fell 0.11%. It fell on 3 out of 4 trading sessions. And the price has unfortunately stayed below the bearish trend line, marking the tops of the Nifty made after October 2021. For the bulls, that's an unfortunate part, but the price is above its 25-day exponential moving average, which is a month-long holding on cost of an average bull. So the short-term outlook remains positive for now. We need this moving average to be defended in case the bulls are to prevail in the coming week as well. The weekly chart on your screen tells you that the week began on a bearish note, but the Nifty managed to claw higher. Although the bearish trend line still remains inviolate, the price is above its 25-week exponential moving average, which is a 6-month holding on cost of an average bull. The gap between the price and the moving average has reduced, which means even if mean reversion and corrective decline comes in, it won't be as big as it would have been earlier. In the week before last, this index was number 9 on our most volatile list counters in-house, and it fell 7 notches to hit number 16. Now that is a big decline because volatility fell. Do remember, the impetus on the Nifty 50 has come down. Last week, I advocated a range between 18,125 on the upside and 17,000 on the downside, which held perfectly well. In the coming week, I expect a range between 18,100 on the upside and 17,000 on the downside. Here again, do trade carefully. A bit of statistical data here for your sake. I looked back on the monthly chart since the turn of the century, and I found out of 21 years in September, 10 Septembers were either flat or mildly down. So, of course, years 2020 and 21 were more of outliers because there was very, very clearly a huge sense of euphoria, which has seen prices rise in September itself. So it's a draw between bulls and bears. But what is for sure is that the range of September typically tends to be smaller, which is why September as a month tends to see narrower ranges. So given a choice between whether the market will favor swing traders who are looking for large price moves or scalpers who are looking for very small moves to get in and get out of the market with small gains multiple times a day, I think that September will most probably favor scalpers. And that is also the outlook for the week ahead. I think scalpers will do better than swing traders. At least that's the weight of evidence based on the past. Let's now see the retail risk appetite by way of their turnover contributed in options and futures. What we are seeing is that stock futures and options denoted by olive green line and light blue line respectively have gone up on a week-on-week basis, which means that there has been higher participation by the retail segment in both individual stock options and individual stock futures. But they seem to have reduced their traded exposure in futures, which tells me that their risk appetite has increased. And risk on coming back is a sign that they are willing to support the market at lower levels, most probably. Now, friends, for the most popular segment of this video for statistical model traders who basically segregate stocks based on the gains in impetus or losses in impetus on a day-on-day basis, This list is valid only for Monday. If you wish to be updated with this list Tuesday to Friday, please join our Telegram channel. The contact coordinates come at the fag end of this video and also in the pinned comment below. And the high impetus gainers for the day for Monday, where you take a small exposure, wait for large price moves, is led by PEL, number 2 Colgate, number 3 GMR Infra, number 4 Ashok Leyland, number 5 Indian Hotels. Impetus losers for the day on Friday, where you take large exposure on Monday and wait for small price moves for scalpers, is led by REC, number 2 Muthoot Finance, number 3 PVR, number 4 MGL, and number 5 Granules India. This hierarchy is subject to change hour to hour, so do keep yourself updated on our Telegram channel. Friends, I bid goodbye to you in this video, not before reminding you to click like on this video if you liked what you saw, subscribe to my YouTube channel if you haven't already done so. In the comment section, I would love to hear from you telling me how you find our work in our YouTube videos, and help me reach out to a wider audience by sharing my YouTube videos with your family, friends, and social media groups. Thank you for your patience and sticking around in this video till we meet again in my next video. This is Vijay Bhambwani signing off for now. Take care. Bye-bye.